Good evening, everyone, and welcome to this edition of the weekly wrap up. Indian markets have ended the week on a positive note. The Nifty 50 was up by about 3%. However, if you're looking at the month to date, the markets are still down by about 5%, and compared to the peak of October 2021, the markets are still off by about 12%. The week was a choppy one, largely because of data coming in from US. In fact, US retail majors, Walmart as well as Target have declared their quarterly numbers, and it was quite poor, so as to speak. There are concerns that US may go into recession, driven by inflationary pressures, and that would mean that the corporate earnings as well as profitability, and especially the consumer demand, could wane off. Now, this did lead to shockwaves around the world, and we saw a major sell off across all of the markets, and India was not an exception to it. Due to the global sell off, the Indian rupee went on to hit an all time low yesterday, and at the same time, we saw a huge sell off happening as far as the technology stocks were concerned, too. Because naturally, the expectation is that if US does go into a recession, then it could hit demand for the IT services. However, on Friday, we saw that the markets reversed the trend to a large extent. This was largely driven by the cues from Asia, which were positive on account of a rate cut announced in China. At the same time, valuations too have become quite attractive. So, any sharp correction that we see on the market front leads to bargain hunting as far as stocks are concerned. In fact, valuations have cooled off quite a bit, and if you compare it with the corporate earnings season, which is going on at the moment, it does merit buying at this particular point of time. Now, one has to keep in mind that the cost base that we saw last year, that was an all-time low, and giving that kind of a favorable base, we may not see that kind of a repeat as far as margin expansions are concerned going forward. However, there are structural themes which are emerging in the markets, and they do call for investing at the current times too. In our opinion, what one needs to do is to have a prudent portfolio mix. This portfolio mix should be of companies which are structural growth stories. So these are typically high quality companies and high quality names which are seeing the next leg of growth coming in, driven by the India consumption story. It could be through the infrastructure story, it could be through housing, export led demand, beneficiaries of China plus one strategy, so on and so forth. We're also seeing companies who have strengthened their balance sheets and at the same time have pricing power. So any increase on the input cost side, they are able to pass that across to their customers, and therefore they enjoy pricing power. And finally, it is prudent to also have a mix of defenses in one's portfolio. Because defenses at the end of the day, they may not rise as much as the markets during a bull run, but whenever there are sharp corrections in the market, they do provide that cushion. So high dividend yield names would also feature in this particular segment. Having this kind of a portfolio, we believe, is prudent and crucial when one is looking at long-term returns, and that is the recipe for building long-term wealth. Now, obviously, there is volatility, and that does bring investors to question whether they should continue to invest at current levels or not. The answer to that is pretty simple. We would always recommend remaining invested even through these volatile times. But for investors who are looking at new money to be invested at these levels, we would recommend having a systematic investment plan or a systematic approach. So that could be carried out over a month or 2 months or even 3 months for that matter, so that they can benefit from the short-term aberrations. But the idea is to remain invested, because equities at the end of the day are the best performing assets when you're looking at 5-year returns or 10-year returns, 15, 25. They have outperformed other asset classes. And we do believe that these volatile times are not going to be permanent, and Nifty will start heading upwards again, and this is the right time to buy. Thank you very much.